So I hope you heard the interview with Minard. Down 20% by mid-October. Your rebuttal, if any, is?
Well, there's a whole bunch of things I thought that I would take the other side of.
Let's hear it.
So first, everybody's talking about recession as if we know what that means, And so we went back just recently and we looked at the last 50 years of recessions to see, what are the patterns. And it really comes down to one simple thing, is that recessions are a disintegration in the labor market. The unemployment rate on average goes up by about 3% in about a year. Roughly what that means is 4 million Americans lose their job around a recession, with a low end on that range of 2 and a high end of 6. So recessions are really ugly things. What you see typically before recession is that the weekly jobless claims, which just came out today better than expected, they start to rise. Companies start to fire workers. That's what normally happens. We've seen that already. But when things are healthy, those workers get a new job and the unemployment rate doesn't rise. And that's exactly what we're seeing right now, which is we're seeing terminations, and you see this, and you guys report on this, but there's so many excess jobs in the marketplace that our work shows that it takes probably from here 18 to 24 months before we work through all of those open job recs till we get to a point where unemployment rates spike. So there is a recession in our future. The question is how far. If it's 6 months from now, you want to bail on stocks, and Scott's right. If it's 18 months, then not the case.
So one of your headlines is historically earnings hold up best when inflation is elevated. He says off the top of his tweet, since 1960, PEs have trended lower when inflation is higher. I mean, both of you can't be right. Why do you think that earnings are going to hold up in the kind of environment that we're in if the Fed is as resolute as it says it's going to be and is now?
Right. So let's unpack that. First, if you look at earnings, what most people quote and look at is the last couple of recessions, we've been in a low inflation environment. And low inflation environments, earnings peak about 15 months beforehand. So, and Scott says something really interesting, which is it's all about real earnings. So earnings are probably not going up in real terms, but in nominal terms they are. We're likely to see earnings continue to trend perfectly fine until that recession actually begins. So if you're looking at the last couple of recessions, you're really looking at an environment that doesn't look like this. This looks more like what we had in the 70s and 80s, and the earnings held up much better. Now, with respect to the Fed, there's a whole different set of dynamics.